What is beta and how does it relate to market risk? Have you ever wondered how some investments seem to soar while others barely budge? This brings us to the concept of beta, a key player in understanding market risk. Beta is a financial tool that helps us see how an investment, like a stock, moves in relation to the overall market. It gives us a sense of how much risk is involved with that investment compared to market movements. Typically, the market is represented by a broad index, such as the Standard & Poor's 500, which has a beta of 1. If an investment has a beta of 1, it means its price generally moves in sync with the market. When the market goes up, so does the investment, and when the market goes down, the investment follows suit. Now, if an investment has a beta greater than 1, it is considered more volatile than the market. For instance, a beta of 1.5 means that the investment tends to move 50% more than the market. So, if the market rises by 10%, this investment might rise by 15%. Conversely, if the market drops by 10%, this investment could fall by 15%. On the flip side, a beta of less than 1 indicates that the investment is less volatile. This means it moves less than the market. For example, if the market goes up by 10%, a stock with a beta of 0.5 might only rise by 5%. Rarely, you might encounter a negative beta, which suggests that the investment tends to move in the opposite direction of the market. Beta specifically measures systematic risk, also known as market risk. This type of risk affects the entire market or a segment of it, and it cannot be eliminated through diversification. Factors like economic changes, interest rates, or geopolitical events can impact this risk. However, beta does not account for unsystematic risk, which is unique to a specific company or industry. This type of risk can be reduced by having a diversified portfolio. For adults who are building their investment portfolios, understanding beta is essential. It helps in assessing how adding a particular stock or asset might change the overall risk of their portfolio. For example, including high beta stocks can potentially increase returns but also raises exposure to market fluctuations. On the other hand, low beta stocks may offer more stability but often provide lower returns during market upswings. By considering beta, investors can align their portfolio risk with their personal risk tolerance and financial goals. In practical terms, beta is also used in financial models, like the capital asset pricing model, to estimate the expected return of an investment based on its risk relative to the market. This knowledge helps investors make informed decisions about which assets to include in their portfolios to achieve a desired balance of risk and return. Understanding beta is a valuable tool for anyone looking to navigate the complexities of market risk and build a well-managed investment portfolio.